Happy Friday, Brian Benny here. Let's get right to it. Oh, happy Friday. I'm not really sure. I think so. Last Friday I did Grateful Friday, and but there's so much to talk about this week that I actually would love to do a market update because mortgage rates have steadily increased from last Monday, March 9th through today. And I get a lot of people asking me, hey, why are rates going up? I heard rates were at all-time lows, and they certainly want to hear what's happening, but a lot of people are just reading misinformation or don't know what's going on. So I apologize in advance if this is a little bit longer than normal, but I think this is really good content for us to talk about right now. So let's just talk about the quick basics. So usually you have, always you have stocks and you have bonds, you have equity and you have bonds. And what that means is you have investors that put money in the stock market. When markets are doing really well and investors are excited, they're going to take money out of bonds and they're going to invest in stocks because stocks are going to give you typically a higher rate of return on your investment. Contrary to that, when investors are nervous, they're going to take money, sell out of stocks and invest in bonds because bonds will give you a guaranteed rate of return. So you usually have money flowing back and forth between stocks and bonds. Well, right now we don't have this normal equilibrium in the marketplace. And the question is why? Because this is what's causing mortgage rates to be higher now. And there's just a couple of key points that people are not talking about. So first of all, starting last week, there was a bunch of margin calls taking place. So people had margin accounts attached to their brokerage accounts. And when the stock values have already gone down so low and a margin call comes in and you need to sell an asset to answer to the margin call, a lot of people have been selling bonds, specifically treasuries and mortgage-backed securities, because the stock value had gone down so low. So you've seen a very large sell-off in the bond market because of the margin calls that were taking place. So that's one really important thing that's driving interest rates, because there's been a big sell-off in the bond market there. Number two, and probably most important, is the stimulus package or packages are taking place. We're talking trillion or trillions of dollars. And when the government comes in and they need to help us as consumers and they need to put all of this money into the economy, how do they do it? Well, they create debt. And by creating debt, they're creating treasuries. So they're about to just shoot into the market more debt that's never been shot into the market before, never created through treasuries. And certainly they have committed to a bond buying program with treasuries and mortgage-backed securities at the level of hundreds of billions of dollars, which is quantitative easing. Same thing Ben Bernanke did to help us out back in 2008, 2009. That's what Jerome Powell's doing right now. But you do just typically have standard economic supply and demand. When you're looking at creating trillions of dollars of debt and you're shooting this debt into the marketplace, the question is how much supply is going into there, regardless of how much the Federal Reserve has committed to purchase. What is the demand for this debt and will it get bought up or eaten up? So certainly watching that and watching the amount of debt that's going to go into the marketplace in the form of treasuries is also causing bond prices to change and mortgage rates to go up. Also this week we had Steve Mnuchin talking, and I know he meant well, but in talking about unemployment, I think he really made a lot of people think and made them very nervous. So back in the Great Depression, the unemployment rate was at 25%, which was just a really horrible level. And when this talked the other day, he talked about unemployment rates pushing up to 20%. So the third factor is this now made investors start to think, wow, with unemployment rate going this high, will the consumer actually have the ability to make mortgage payments? So now you have investors looking at the risk factor, associated with these payments for mortgages. So you're seeing mortgage-backed securities get priced in based on the risk factor. So with anything investing related, the higher the risk, the higher the rate of the return needs to be. So now when you have investors looking at this and wondering, what is the economy going to look like? What is unemployment going to do for people's ability to make these mortgage payments? Potentially there's a higher risk. And when we see a higher risk, we now want to see higher rates here as well. So that's another factor that's going in that's causing mortgage rates to go up. So yes, we are in a rising rate environment. And we're likely going to see a rising rate environment for a while because a couple reasons. One, there's just uncertainty in the marketplace with investors. And two, until we start to see the economic data come out, we start to see what happens with unemployment, and we start to see how us as Americans are making our mortgage payments, that's also going to kind of factor into the risk versus reward for mortgage-backed securities, and it's going to help investors figure out where they need to be. So uncertainty, risk versus reward, also capacity issues on the mortgage side. All these reasons, debt we talked about getting pushed in, everything that we're talking about right now is why mortgage rates have gone up steadily since last Monday, March 9th, and will continue to go up. I'm around all weekend. If you have any questions, give me a call. I'd love to help you any way I can. I hope you're doing okay. I hope you're staying safe. Hope you have a wonderful Friday.